Ladies and gentlemen, good day and welcome to Q3 FY24 earnings conference call for Maharashtra Seamless Limited, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Singh from PhillipCapital India Private Limited. Thank you, and over to you, Mr. Vikas.
Thank you, Manav. Good afternoon, everyone. From Maharashtra Seamless Q3 FY24 earnings call. From the management side, we have with us Mr. D.P. Jindal, Chairman, and Mr. Kaushal Bengani, Senior Manager, Investor Relations. Without taking any more time, I'll hand over the call to Mr. Kaushal for the opening remarks. Kaushal, over to you.
Thank you, Vikas. Good afternoon, and thank you for joining our earnings call. We are proud with our outperformance in Q3 FY24 with the achievement of highest EBITDA and improvement in margins, both of which were accomplished in the backdrop of strong performance in second quarter of FY24. We are pleased to inform you that our core operations have gone from strength to strength as we continue to exceed expectations by working continuously with an intent to create value for all stakeholders. In Q3 FY24, like we have done in earlier quarters, we have improved upon our margins and have achieved highest EBITDA following strong execution of orders and better marketing initiatives. I will briefly summarize key financial indicators. On comparison with corresponding quarter of last year, that is Q3 FY23, our revenue in Q3 FY24 increased by 8%, EBITDA increased by 51%, PAT increased by 67%, and EPS increased by 62%. When we do a comparison with last quarter, Q2 FY24, although our revenue dipped slightly, however, EBITDA increased by 11%, PAT and EPS both increased around 10% on account of improvement in margins. On reviewing our 9-month FY24 performance versus 9-month FY23 performance, revenue increased by 4%, EBITDA increased by 30%, PAT and EPS increased by 56%. This performance reiterates strength in our operations despite volatile macroeconomic environment and inflationary pressures. Our ability to control costs remains unmatched as the same is achieved without compromising production and sales. Apart from financial indicators, there are 5 key points which we would like to draw attention to. The first is the status of capital expenditure. We had commenced our plans of capital expenditure by acquisition of land for installation of finishing facilities at our Telangana unit in previous quarter. We have placed order for certain equipment and are in the process of placing orders for other relevant equipment. We expect this installation to be completed by December 24. We are a 100% debt-free company. We currently have liquid investments of almost 1,500 crores. I take this opportunity to communicate yet again that our treasury will only be utilized for core operations and shareholder benefit. They shall not be utilized for any other activities. In Q1 FY24, we were made part of the Morgan Stanley Capital Invest India Domestic Small Cap Index. Apart from index rebalancing, we have received tremendous interest from foreign institutional investors who have increased their holding from 2.84% to 10.5% within a span of 9 months. The DII and FII holding currently stands close to 15%, which is up from 7% at the start of this financial year. The fourth point is in relation to the market demand. I wish to reiterate that capital goods and infrastructure in general and oil and gas specifically continue to witness strong demand in short to medium term. This directly impacts the seamless pipes market. Our seamless pipes market remains buoyant, driven by capital expenditure and spending in oil and gas sector, as we are seeing our order book being replenished and maintained at good level. Our investor engagements have also improved significantly, and we have represented Maharashtra Seamless in 4 investor conferences this year and expect to participate in at least 2 more. I would now like to take you through the presentation. The first few slides detail the various activities of the company. Slide 5 is about the quarterly performance over past 5 quarters. You will note a significant jump in EBITDA and PAT margin over the past 2 quarters. The next slide is a profit and loss comparison on quarterly basis. A key point to note here would be the reduction in other expenses that we have managed in this quarter, highlighting our strong operational performance and our ability to control costs even in inflationary environments. The next slide is about the annual performance of previous years. Slide 8 is the operational and financial performance of the company. Whilst in the third quarter, production has been slightly lower than what it was in previous quarters, sales have been more and margins have been better than previous quarter. A 9-monthly comparison of FY24 versus FY23 will clarify the improvement in margin that we have achieved along with similar levels of sales. This has been on account of better marketing initiatives by our marketing team. The next slide is about the EBITDA mix of Maharashtra Seamless. As always, almost 85 to 90% of EBITDA is from the seamless segment, and that's the trend that we expect to continue. A point of interest for various participants are the ICDs, which remain on a declining trend. Currently, they are at 14 crores and will be fully realized by March 24. This was committed by us over the past year and a half, and we are on set to achieve this. Liquid investments as on December 23 are at 1,465 crores. As is apparent from the table on this slide, liquid investments have tripled over past 2 years. Corporate guarantee continues to reduce as was committed, and slide 13 updates on the same. The capital expenditure plan for FY24 to FY26 is detailed on slide 14, which we've also communicated earlier. Entire capital expenditure will be from internal accruals, and there will be no requirement of any debt. Order book as on 26 January 2024 stands at 1,563 crores, which is a good level. We expect margins to remain steady based on current trend of seamless pipes prices. And a few days ago, we received a contract from IOCL, which we have communicated, indicating the buoyancy in the market. There's a sales and marketing update given on slide 17. I would like to read a couple of points out regarding the activity which is taking place, which will help participants understand where demand is originating from. Orders from ONGC and Oil India are being procured and dispatched rapidly as domestic demand is robust. ONGC has made significant natural gas discoveries in the Mahanadi Basin. These discoveries were made in a restricted area which was opened up. New oil blocks, Amrit and Munga, have also been recently discovered in Mumbai offshore. Oil companies are drilling additional wells as E&P activities have increased. This has been driven due to elevated crude oil. Existing orders for drill pipes, which are a value addition and import substitution product, are also being dispatched. We expect fresh tenders for drill pipes in FY25 as domestic market size is around 10,000 tons. I've spoken about the IOCL order, which we have received a few days ago. The next slide details various marketing trends which are in place, and I would request all participants to take some time out to go through slide 17 and slide 18 so that they are able to understand the growth which is possible in this market and our market leadership position in the same market. Slide 19 talks about the key changes in the shareholding structure, which I touched upon earlier. I would now like to hand over back to Vikas and request him to open the floor for questions.
Thank you, Kaushal.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to only use the handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Jatin Damania from Swan Investment Managers. Please go ahead.
Hi, sir. Congratulations for a great set of numbers. So I just have 2 questions. So basically, how is the demand for seamless currently, and what would be the sustainable EBITDA per ton for the same? Because we are seeing sequential improvement.
Demand for pipes is good, as is reflected by our existing order book of 1,565 crores. Very recently, we got a new contract from IOCL of 116 crores, which we have communicated. The margins that we are seeing, they are very good margins. Generally speaking, our margins have ranged from 9,000 rupees a ton to 30,000 rupees a ton. So depending on the position of the order book and the cost of raw material, we will get the necessary margin. It is difficult to specify a number because we have short duration order books of around 3 to 4 months, which is replenished on a daily basis.
Okay, sir. That's it from my side. Thank you, sir.
Thank you. We have our next question from the line of Riya from Aequitas Investments. Please go ahead.
Hi, thank you for the opportunity. My first question is how much percentage of the revenue is currently exports, and similarly for order book?
Exports are less than 10% of total revenue. Whilst export demand has not picked up over the past 9 months, it has not had a meaningful impact on the company because domestic demand is very good and we've been able to sustain and improve upon our margins primarily on the basis of the domestic demand prevailing.
Got it. Also, your other expenses as a percentage of revenue has significantly declined in this quarter. Is there any one-off savings in cost this quarter?
No, actually what had happened was in the previous quarter there were certain administration and selling expenses which were on the higher side, which did not happen in this quarter as we've been able to control our costs.
This would be the normal range for other expenses?
Yes.
Got it. Also, in terms of orders from Oil India and ONGC, we're seeing it around 500 to 600 levels. However, a few quarters earlier, we saw it at around 1,800 crore levels. So, what kind of pipeline are you seeing right now?
Every year, Oil India and ONGC, they come out with tenders. So the tender that is awarded is usually a good size tender.
Annual requirement.
It's part of the annual requirement of ONGC and Oil India. So when we had reported the number a few quarters earlier, as you said, we must have received the order, let's say 20 days or 10 days prior to the date of reporting, which is why the figure was higher than it is right now.
Also, in terms of going forward, election is coming ahead. So, do you think the pipeline or the order inflow for some time for election would be a little dry?
Very short time impact.
Okay, very short time.
Any meaningful impact.
Got it. I think that's it from my side. I'll join the queue for further questions.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. We have our next question from the line of Rahul Jindal from Summer Wealth. Please go ahead. Mr. Rahul, are you there? I would request you to use the handset. You are not audible.
Please check now. Am I audible?
Yes. Please go ahead.
Sir, I wanted to know what growth opportunity do you see as a market leader for upcoming years after enactment of this anti-dumping duty?
Anti-dumping duty is in place till October 2026. We expect the duty to continue going forward, considering the government's impetus towards Make in India and Atmanirbhar initiatives and the way domestic industry is performing in the past few years.
Sir, any volume growth guidance?
We have put out a capital expenditure plan in our presentation. We currently have production capacity of 1 lakh tons, which is inactive at our Telangana unit. In order to utilize that production capacity of 1 lakh tons, we are putting in a finishing line at the Telangana unit. Once that line is in place, there will be an immediate improvement in the tonnage that we are able to produce.
Okay, sir. Thank you.
Thank you.
Thank you. We have our next question from the line of Simran Bhatia from Almond Financial Service Limited. Please go ahead.
Yeah, thank you for giving me the opportunity. There are two set of questions I want to ask. First, in terms of the operating margin, let's say in FY25, how we can expect it should be there. Can you answer this first question?
As we have mentioned earlier, we maintain short cycle order books of around 3 to 4 months. Therefore, going into FY25, we will not be able to give you an assessment of the exact number. But generally speaking, margins are good because market is good.
Okay. And sir, my second question is that the promoter stake has increased to 68% from 63% in the past 2 years, and you are committing for 75% promoters. So when we can expect this to increase, any tentatively timeline in next couple of years or in next couple of months?
There is no fixed timeline. It is an interest of the promoter to increase their stake to the maximum possible level, but there is no defined timeline.
Sure, sir. Done. Thank you.
Thank you. We have our next question from Sneha Talreja from Nuvama Wealth Management. Please go ahead.
Hi team, congratulations on good numbers. Just one question from my end. If I look at your seamless volumes on a 9-month basis, that seem to have declined. But despite that, I see EBITDA per ton increasing, substantially. What are the key reasons in case you can highlight? One of the reasons I understood was savings in other expenses, which was particularly for this quarter. But on an overall basis, what are the reasons of increase in EBITDA per ton?
The main reason for increase in EBITDA per ton is the good domestic market that is currently in place. You will note that export started declining from April onwards. However, our margins started to improve from April onwards compared to a situation in March when exports were good. So domestic demand is good, and that is a key growth driver for the company. Our marketing team is also befitting of our organization because they have engaged in better marketing and sales practices.
And another point was the raw material price has declined. So our order price were good, but the raw material price has declined.
Just to follow up on that, while your raw material prices have declined, what I understand is you have back-to-back orders also. How did it end up benefiting you?
No, it was not fully 100% back-to-back, but whatever new raw material we have purchased, the price of steel was low.
What percentage of your raw material requirement is back-to-back hedged?
We don't want to disclose that, but majority of the orders that we have are supported by back-to-back booking of raw material, which is why we are able to sustain and improve upon margins even in volatile environments.
No, I tell you example. Suppose today we get order from ONGC or Oil India at a higher price, say 1 lakh rupees per ton. So, but the steel price has came down. So, this order we have quoted, say 3 months back. In 3 months, the steel price has come down. So, we are booking at a lower price.
Understood. That example was helpful. Just one last thing from my end. What is the current differential between, or what is the general differential between exports margin versus domestic? Which is a better margin business to be in?
Well, almost we compare both the market. We would like to take the same margin in the export, but because of the export market is weak, so we are booking less quantity.
Otherwise, on the margins front, both are almost similar, you mean to say?
I will say if we reduce the margin in export, we can book more quantity, but we have a domestic quantity, so we are not booking exports.
Understood. Okay, got it. Thanks, sir.
Thank you. We have our next question from the line of Radha from B&K Securities. Please go ahead.
Yes, sir. Hi, congratulations on good performance. Sir, I wanted to understand what kind of volume growth are we targeting for the next 2 years in both seamless and ARW?
On the seamless front, we are putting in a finishing line at our Telangana unit. Once that is in place, we will see volume growth coming in. On ARW front, we will be producing similar quantity that we produce this year. So in fact, there is likely to be volume growth in the ARW segment in FY24 versus FY23.
Yes, sir. I was asking about FY25 and 26 because even if
it has been in FY24 for ARW. For seamless, it is a function of how quickly the Telangana finishing line will be in place. But
Sir, okay.
considering our order book, we expect good production.
Okay. So actually that Telangana line for 1 lakh tons, that will come by December 24, you mentioned.
It will be completed by December 24 and start by January 24.
Yeah, it will affect 25-26.
Okay. And so what is then other than that we have 5.5 lakh tons of seamless. So what could be the max utilization that we can do with this 5.5 lakh tons?
It is a function of product mix.
So with the current product mix, what could be the numbers that we can achieve?
We can achieve higher production, but often we get different size orders, and our objective is to maximize profit rather than maximize production.
Okay, and so secondly, this Telangana line, I believe that this has you can expand this to 3.5 lakh tons also in the future.
No.
So, no?
No, we've never said that. Currently, the capacity for the Telangana unit is 2 lakh tons production capacity, out of which 1 lakh tons is the finishing capacity available. Since there is a bottleneck of 1 lakh tons on the finishing side, we are putting that up.
Okay. Thanks. Thanks and all the best.
Thank you. We have our next question from the line of Amit Kumar from Determined Investments. Please go ahead.
Yeah, hi gentlemen. Just two questions. One is, what would be the share of export revenues on a 9-month basis? And, this new Telangana, finishing line that you are putting up. So next year or, the year after, do you believe that, domestic demand would be sort of enough to fill that capacity, or would you again need to, look at export markets?
We'll be looking for the export market mostly.
Okay. And what was the share of, exports? As you said, it started declining from April, but on a 9-month basis, for 9 months also less than 10%.
Yes, yes.
Okay, understood. Thank you. That's it from me.
Thank you. We have our next question from the line of Prince Dharana from Prompt Hospitality. Please go ahead.
Hi. First of all, congratulations to Maharashtra Seamless. I have one question. I just wanted to know the revenue recognition policy of Maharashtra Seamless. Is it like is the revenue booked as soon as the order is received, or is it recognized as and when the inventory is dispatched? And I have another question. Like the number of rigs count is increasing in US and Canada. So why is the export orders for Maharashtra Seamless not increasing? So yeah.
So revenue recognition as per Ind AS requirement is on basis of dispatch. When we dispatch the pipes, we
all right.
On the question regarding exports, we mentioned earlier that if we decide to reduce prices, we can get a lot of export orders. But our objective is to maximize profit rather than any particular segment.
And domestic demand was more, so to meet the domestic demand, so we have booked less order in the export.
Perfect. Thank you so much, and congratulations. Thank you.
Thank you. We have our next question from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Namaskar, Kaushal-ji, namaskar, Jindal Sahab. Sir, firstly, if we take the volume number for the last year in terms of for the seamless in particular, we did 431 of production, 431,000 and 436 as our sales. And as of now, we are slightly lower in terms of the run rate. We have done 302 for seamless. So what should be the probability taking into account the shorter duration order books we have? what should we end the year, sir, on top of 436 sales volume, which we have done for FY23? Sir,
in FY23, as you said, we have dispatched 436,000. We were targeting a higher level or similar level in FY24. However, we've got some good value orders, and there was also maintenance in one of our facilities, which is why production and dispatch has been lower. If you take an average of our performance in 9 months and extrapolate it, we think we'll get that level of tonnage. However, I would also like to point out that despite slightly lower level of tonnage in FY24 versus FY23, you will see that our profit that we have been able to generate in the past 9 months is slightly less than the profit that we've been able to generate in the past 12 months, in the 12 months of FY23.
Yes, sir, that is clear. I was just trying to understand whether the current order book also will it translate into higher tonnage, or is it the similar type of orders which we have executed in Q3 that will percolate going ahead for Q4 also? If you could give some color on that, so that even on lower tonnage, yeah.
So what we have done in the first 9 months, if you can extrapolate that on pro rata basis, then that is what we'll likely to achieve, slightly better than the pro rata levels. That is what.
That is the volume part, sir, you are mentioning?
Yes, sir.
On the volume, and also on the margin part also, sir, since you have the low duration order books and you know the current raw material basket also shaping up, so extrapolating these two factors, do they give the same color mix? If we take the 9-month average, we can come to a conclusion that margins will be in this band?
Well, let me tell you, our seamless EBITDA was 30,000.
Yes, sir.
So it's very difficult to maintain 30,000. But we will certainly be averaging out, say, 20,000. I'm not talking about the quarter 4. Quarter 4 order booking is good, but in next year, we will be aiming at 20,000, not 30,000. 30,000 is quite high in data.
So just to harping again on it, so we did 9-month average at 27,137.
9 months, okay.
Yes, 9 months average is 27,137. So going ahead, looking at the status of the order book, that can we look forward for 27,137 to average out for the full year, or even now the mix is over? जो आपके value added segment says वो execute हो चुके हैं, and going ahead we are expecting a lower EBITDA per ton for the fourth quarter.
This quarter, of course, the order booking is at a good price, so I think we can maintain this.
This 27 number can be maintained.
Yeah.
Oh, okay, but for next year, you are saying that it will be difficult to sustain this number of 27.
That's right.
Okay, sir. So, but what has led to this this special order book value added segment? सर ये क्या इसी छोटे काल के लिए ये कार्यखंड के लिए है और उसके बाद ऐसी ऑर्डर वापस नहीं आएंगे सिस्टम में? What is the speciality of the?
I told you the market was bouncing and the prices were high, and meanwhile the steel price going down. So we have got the differential benefit.
Correct.
Yeah.
Correct. Yes, sir. Sir, if we look at also for the rigs part, I think so. जैसे earlier participant also mentioned that the rig count has also improved, and I think so. आपकी दूसरी कंपनी में जो लास्ट आपने जो रिग चार्टर रेट पे लगाया है, that is significantly higher. So outlook for the one rig that Maharashtra Seamless holds also looks promising going ahead. I think so 1 year is now left, 1.5 years for this to get dechartered. What should be the trajectory going ahead with rig business in MSL? If you could give some color.
Now the price is around 40,000 per day. So we expect the new rate contract more than 80,000.
It's 80,000. And this will be continuing, we will continue with the rig business as in the opening you have mentioned that unrelated segment other than seamless segment we won't be investing further. So we will continue with this rig proposition. We will have these two verticals going ahead also.
Well, we have to take the appropriate decision at the right time.
At the right time.
Yeah, right.
Correct. And sir, lastly, sir, about the shareholders, well, there has been a tremendous shareholder value creation that has happened over the last 2 years. And I think so, sir, now depending on the cash flow and also on your capex, we were looking forward for a dividend distribution policy or the returning of cash back to your investors. So when can we hear something concrete on the same, sir? And where are we, sir, in midst of this thought process? I think so. This has been long pending request from investors. So, sir, अभी हम इसके लिए हमें क्या मार्गदर्शन देते हैं, sir?
We are looking for a good opportunity for expansion. If that is not there, certainly we have to give it to the shareholders.
Correct.
Yeah.
ठीक है, sir. I will join the queue again, sir. Thank you and all the best, sir, and congratulations for a stupendous set of numbers.
Okay.
Thank you.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask question. We have our next question from the line of Vivek Chaturvedi, a shareholder. Please go ahead, sir.
Hi, my questions have been answered. Thank you.
We have our next. Yes, sir. We have our next question from the line of Mr. Vikas Singh from Phillip Capital India. Please go ahead.
Hi, sir. I just wanted to understand our hot mill upgrade in Nagothane, which we planned for 350 crore. What is the benefits we will derive out of it in terms of tonnage or the cost savings? If you could give us some idea about this.
Present capacity is 14 inch.
Just 1 second, Vikas.
Yeah, it will give two benefits. One is capacity increase, and the second is the quality also will be better. So capacity will be around 1 lakh ton more production.
So effectively, we will become 750,000 tons of seamless pipe company.
Utilization will be 1 lakh ton more.
Understood, sir. And in terms of OPEX, how much cost savings we can expect?
Okay.
So there will be better utilization will lead to economies of scale within the existing capacity.
Sure. That's all from my side. Operator, if you have any other.
We have our next question from the line of Ankush Savaria, an individual investor. Please go ahead.
Good afternoon, sir. Congratulations on a good set of numbers.
Okay.
Sir, my question is that according to the presentation, you've shown that your capex and your working capital will be taken care of by the money that you have in liquid assets as of now. That would be in a span of next 2 years. By then, you will also accrue cash in terms of net profit. So what are you thinking of doing with the extra money that you will generate in next year or two?
Yeah, we will see any opportunity if it comes in the pipe segment, so we'll take over the company or we'll expand in those lines.
So do you have anything in eyesight, or you are just hoping to have it?
We are just hoping.
So wouldn't it be great that you can increase the dividend next time so that the investors can also benefit from it?
Certainly, we are working for investors only.
Okay, and one more thing, sir. You have already split your shares, but still I feel that the liquidity in trading on your shares is very less. So do you have any consideration to split it further?
Split?
Yeah, because right now what is happening is that while we...
Maybe at 2000 level.
Okay, at 2000. And my last question is, sir, repeatedly you have said that the promoters are eyeing to increase their share. Do you still have it in mind, or it has become very difficult to do that now?
Increase what?
Increase your promoter share.
Yeah, because certainly we have planned for going for 75%.
But the individual...
Again, you say the liquidity in the market will be less than.
Yeah, that is what I'm saying. That right now it is only 17% with the individual investors.
Right.
If in case you increase by 7%, so total will be left is 10% for individual investors.
That's right.
You will have to find some other way out, I think.
Correct.
Okay, sir. Congratulations on a great set of numbers, and you are doing great.
Thank you.
Thank you, sir. We have our next question from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Yeah, congratulations to the entire team for excellent performance both on the number side and on the balance sheet side. So a few questions. First, on the order book, what we have been seeing for last 6 to 8 quarters is normally the order book number is up to 1 quarter or 4 months of sale, as compared to 2 to 3 years back when ONGC particularly used to give a visibility of almost a year or so. So what's your take on this? Do we see this will continue and your order book visibility will continue to remain at 3 to 4 months, or any long gestation orders are also in the side? Because your presentation also mentioned that ONGC has 2 to 3 discoveries, so they will be having a long-term program on drilling and all that. Then why do they do short gestation orders?
So earlier, let's say till before 2020, ONGC used to come out with long duration orders in which they would issue tender for requirement of over the next year. That has changed since then. Now ONGC comes out with lower value orders for lower duration. This has been in place for the past 3.5 years, and going forward, we expect good orders to come in, because we are one of only 3 participants in the market, and we are the market leader.
Okay, so you expect the short duration orders to continue, particularly from the ONGC side?
Yes.
Okay. Second thing on the margins, obviously last few quarters we have seen exceptionally very good margins, but not sustainable on long-term basis. Historically, your margins used to be 14,000-15,000 rupees a ton. So what can be the new normal now? One is depending on how the grades have changed over last 2 years, and your overall sales mix includes some value-added component, also taking that into consideration. What can be the new normal?
So we've had margins ranging from 8,000 rupees a ton to 30,000 rupees a ton in the third quarter. It is difficult to specify a number because it is a function of the selling price and the price of steel at any given point in time. But generally speaking, margins are expected to remain good because market is good and we are a market leader.
Great. Thank you, and best of luck. Yeah.
Thank you.
Thank you. We have our next question from the line of Vinay Nadkarni from Hathway Investments. Please go ahead.
Yeah, I have just two questions. One is on you had said oil and gas is contributing to how much of your total requirement, and I mean how much of your production is consumed by oil and gas, and how much is by other sectors. Because we have been talking of oil and gas growth. Is there any growth happening in other sectors also?
Yes. Our contribution to oil and gas, rather than contribution, our exposure to oil and gas sector is around 70%. The other segments that we cater to are boiler segment and general engineering. We see good demand in the boiler segment as well because those pipes are used in the power sector as well.
Okay. And the second question is on your ERW margins per ton have kept going down compared to last year. Any particular reason?
ERW figures which are reported, they are actually a function of two different types of ERW pipes, one for the water sector and one for the oil sector. Depending on the type of ERW pipe which has been dispatched, the margin for the quarter is determined.
Okay, so for the last 9 months,
oil sector orders are higher margin than water sector orders.
Okay, so the last 9 months you have been more of water sector product, is it?
It's a mix of both.
Okay, and last question on capacity utilization. Once you get your 100,000 ton capacity addition in December 24, what is the current capacity utilization? Are we above 90% or something? And how will we use that additional 100,000 tons that will come in?
In terms of tonnage, we are at 70-75% level. However, that is not an accurate way to look at capacity utilization because if you take a situation where the production facility manufactures small size pipes versus an exact situation where the production facility manufactures large diameter pipes, then at the end of the day, at the production facility where you manufacture large diameter pipes, you will see higher tonnage versus the other situation where you will see lower tonnage. So if we measure capacity only in terms of tonnage, then it will not be accurate. A good way to look at it would be in terms of meters of pipes manufactured. Maybe at a later point in time when we have necessary data available, we'll start denoting capacity in terms of meters of pipes that we can make because that is then not influenced by the size of the pipe. Right now, we believe we are operating at very high capacity utilization levels. However, that is not reflected because of the size issue, the product mix that is in place.
And the 100,000 tons that gets added, you will have orders to consume that as well as 70-75%?
Yes, we want to target the export market primarily for that.
Okay, thanks a lot. Thank you very much.
Thank you.
Thank you. We have our next question from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Thank you for the opportunity, sir. My question again comes on the total liquid cash that we have in our hand. Since there is no serious look out for a company to outright purchase and secondly with so much cash our ROEs are getting impacted and paying dividend eventually the investor has to pay tax at 30%, right? And also the promoter is quite interested in increasing the stake. So you can at current cash level easily go for a 5% of your total float as a buyback. I mean, with promoter not participating, automatically their stake will increase to almost 70-71%. So why is the management as of now not considering it? I mean, it is helpful in every way, right? All your attributes are going to improve on the financial point of.
So when you make the statement that there is no serious effort in place, I take issue with that statement. That is not the case. We are actively on the lookout for opportunity, but we cannot create opportunity out of thin air just because one doesn't exist. When we make that statement, please note that United Seamless was an acquisition which we identified and that generated significant benefit for the company. We have also put in a lot of effort to look at other assets such as ISMT and OCTL, but they did not materialize for no fault of the company because there are other factors in place which are beyond our control. As of now, we have enough cash for such an opportunity and we want to conserve that cash going forward because we are taking a long-term view rather than a short-term view of just trying to improve market capitalization. What we believe is if we take a long-term view and we are able to set up more manufacturing units at a price that is comfortable for us and is inherent of our competitive advantage, then we'll be able to generate long-term sustainable shareholder value creation.
Thank you for the detailed explanation on the and yeah, surely United Seamless was one of the very brilliant acquisitions, I would say, because the EBITDA per ton, etc., that generates from the product is quite high. Also, sir, on this 1 lakh capex, 1 lakh ton capex that is going to kick in by December, is the product anything different from and nature of the product different from what we are doing right now?
No, it is the same product.
Some treatment facilities will be there.
Sorry?
Product will also be there in addition to our existing product.
Okay. Got it. Yeah. Thank you. That's all from my side. All the best, sir.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Vikas Singh for closing comments. Over to you, sir.
On behalf of Phillip Capital, I would like to thank Maharashtra Seamless Management for giving us the opportunity to host the call. Now I hand over the call to the management for the closing comment.
Thank you, Vikas.
Over to you.
Yeah. Thank you, Vikas, for organizing the call and for covering Maharashtra Seamless. We appreciate your efforts specifically and we thank all shareholders for participating in the call. We request you to kindly go through our presentation in detail so that you are able to understand the company better. I would also like to thank Mr. Jindal Chairman for taking time out to participate in the call. We are focused on a set path which we have internally decided and we want to continue on the path because we've been able to create value for everyone involved.
Thank you, investors. Thank you, Vikas.
Thank you.
Thanks.
On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us and you may now disconnect your lines.